Every central bank says the same thing. 2%, 2%, 2%. Well, here in this video, we're going to look at 3%. You came here for the truth, so let me unveil that for you. What if 2% couldn't happen? What if 3% became the new norm? Well, I'm going to show you one example of the suggestion that this is in fact what's coming. You see, they've been telling us all along that they've been trying to achieve a 2% inflation target. When there was apparently no inflation and there was only deflation, they were saying, we're trying to get to 2%, we're struggling. And then inflation went berserk. And they said, we're going to get it down to that 2% mark. Why 2%? Well, they want to make sure that they burn just a little bit of your money each and every single year. Not enough for you to revolt, but enough that it makes sure all of your hard-earned wealth gets pushed to the 0.0001%. That's right. So what we have here is a new world in which it's not 2% anymore, but it's 3%, acclimating you to more inflation. What happens if they cannot get it down to 2%? Well, they simply lift their target. Now, I've been talking about that a long time because it was plainly obvious that we have this arbitrary target of 2%. They could say, I suggested that they would have sort of a sliding target in between 2% and 3%. I've said that many times. But in this case here, we might just see the admission that 3% is the new 2%. All right. The Fed cannot cut rates as fast as the market wants. So in this article, they're just basically talking about how the bond market is dictating one thing. You've got employment when it comes to the civilian labor force participation rate, looking at all these things, factoring in everything. You then have an issue where we can't necessarily cut interest rates as the market thinks will come. Well, let's break that down a little bit further, shall we? We should look at this question. The Bank of Canada will study lifting the inflation target ahead of 2026 mandate renewal. Bank of Canada will consider higher inflation target in 2026. That's according to Macklem. Macklem is like the equivalent of Jerome Powell in Canada. So what do we have? Well, that 2% target, like I said, it's just a number. It's arbitrary. They don't have to do 2%. There's nowhere written in stone that it has to stay at 2%. But that could mean that at some point in the future, they simply say 3% is the new 2%. And so obviously you and I both know that the inflation rate is not 2% and it's definitely not 3% either. But we're talking about in their world, their numbers. And so it's very interesting to see what they are willing to put on your back. Because, of course, inflation, you got to feel the brunt of it. You have to put that weight on your shoulders and carry it each and every day. When you go to the store, when you have to pump your gas, all of these things cost money. They cost more money than they did before. Some things are subsidized. Some things are a little bit messed up and skewed, but overall things have become much more expensive, both services and goods. But is it greedflation? Is it? It's part of it. But more importantly, what enables that greedflation to take place in the first place? Yes, it is a devaluation of the currency done by these people here. The central bankers only have one mission. I think it's price stability and full employment, right? Yeah, price stability, full employment. That's what Jerome Powell said. Actually, they have one thing, and that is to destroy the currency. You see, that currency, it's owned by them. It's owned by the central bank. It's not owned by you. It's not owned by your government. Look at your bills. If you're in the United States, Federal Reserve note. It's not you. It's not your government. It's the Federal Reserve. Not exactly federal, but that's who controls your currency. And they have one very, very obvious plan. and that is to devalue until there's nothing left. There should be nothing left. Why? Because if you collapse it, well, then you can create something new in and from its ashes. That's where we go. Bank of Canada chief says rates can't fix high housing costs, saying basically, okay, we've increased interest rates. All right, people can't afford homes. So if we just like drop interest rates down, will that help? Okay, no. Do we have to keep them up higher? Is that going to help? He's saying that you've got structural problems. There's not enough homes. And of course, the government has to create affordable homes. All right. There's so many problems in Canada with real estate. It's shocking. It's truly shocking. And they try to like squeeze people, put a vacant home tax, put a foreign buyer's tax. Nothing has slowed it down. Absolutely nothing. First of all, they are unwilling to increase interest rates to the level they need to be because they want to make sure that civil unrest doesn't happen. But there's more to it than that. It's a game. It's a game that they love to play. Effective Fed rate has already fallen substantially. So when we take into account everything, you're seeing this here, just the breakdown. When we look at it, I think for a lot of people, they just need to realize that there's not just the Fed funds rate that's important. There are many different indicators that come through. I talk about it with the money mirror method. If you want to look at that up online, you could see that with the Fed net liquidity. All that means is like how much cash, how much liquidity, how much stuff is being circulated, and if there's a lot more than normal or is it a lot less than normal. If there's a lot more, that means asset prices can rise. If that's going away, well, then asset prices could fall. It all depends on where the money's coming from. It could come from outside suddenly. If everybody in China starts dumping their cash in the United States, that could make up for the shortfall that could be seen from, let's say, the Federal Reserve not printing money anymore, like we've seen recently. Worldwide easing in conditions points to global upturn. So this has already started. That's what this chart shows us, that overall in the world, more and more central banks have started to go in the quantitative easing, or more specifically, started to cut interest rates. Overwhelmingly, they've stopped raising and kind of said, hey, I think we're ready to start cutting at some point, but we're not there yet. That has started to turn a corner. And that means easier money, risk assets are desirable. Global financial conditions will ease further. So looking at this, you can see it one after the other, but conditions want to be easier. They just want it seems. More money printing would throw gasoline on this fire. Global yield curve has uninverted. But this is where things could change, because we've seen this before frequently, very frequently. When it uninverts, that is generally a sign that a recession is coming. And so, whether there is or not, I mean, we've seen many, many very important people talk about it, saying it's coming. How bad it will be, that's a different story. I'm wondering what you think, if there will be an admitted recession, or if they'll kind of just sweep it under the rug. I want to know what you think. As always, Compass is available to you. Hit that thumbs up button first. Before I talk about that, hit that thumbs up button to support me, support the channel. I appreciate that. Compass is the place for a financial education you can't get elsewhere for free, because this is where you can go through. I purposely put these videos together for free. No paywall, no email, no nothing. You just come to the page. You get 20 minutes on these really short videos that you might already know everything, certainly, but you've probably got someone in your family, your friends, your coworkers who can check that out. Compass is a place, by the way, doesn't link to my YouTube channel at all. Doesn't link, there's no link. You just, themoneygps.com/compass. You won't even know that there's a Money GPS, okay? You just go there, you can give them that link, they could watch the financial education, and then you could have a good conversation, all right? Because they'll have the fundamentals and foundation right down packed. I hope that you will check that out, themoneygps.com. There's always a link in the description for that. And as always, I'll see you tomorrow. Take care.